So let's start for today. So very quickly, firstly, I'm going to round up on the application of share-based payment transactions. Deferred tax implication of share-based payment transactions. So far, what we have looked at for share-based payments, we already know that share-based payments deal with when entity receives goods or services and in return they pay with their equity instruments. And this can happen either as equity settled, where they solely pay with their equity instruments, which could either be equity settled or cash settled. Sorry, solely with their equity instruments, which could either be their shares or their shares, or it could be cash settled, which could either be the entity receives goods and they would eventually pay money, but this cash they are paying is based on their share price, or it could be a mix of the two, where the supplier has a choice of settlement. We are not really going to look at this because this is beyond the scope of what we want to learn. So basically, it's going to be between this and this that you would find in your exam. So now, that being said, we then looked at how you recognize equity settled and cash settled transactions. We say it's when cash is when the goods or services are received. We went on to the measurement, and for these two, the focus regarding the measurement is understand that at each intervening period or at the end of each reporting period, what we actually recognize for that year is the number of employees that will vest. And there's no way you can know the number of employees that will vest rather than making an estimate. So it's the estimate of the number of employees that will vest. So at the end of every year, we'll look at that, multiply it by the number of share options. For equity settled, we'll multiply it by the fair value of that share option at the grant date for each year. But for cash settled, we usually multiply it by the fair value of the option or the share appreciation rights, depending on the instrument, at the end of each reporting period. So that is quite so basically, those were what we looked at under share-based payment. Then we looked at some calculations to address all of these issues. Hello, yes, on class room. Me, they communicate below on class already. Sorry. So then we looked at some workings to explain all of that. So in the last two classes, we have spent a lot of time on that. So I don't want to waste our time on that again. Then we also looked at modification last week. And also we looked at cancellation and we solved question on each of them. Then we went to measurement of cash settled. We looked at that also, solved this question. So today, this one is the third one. So we are not going to look at this. It's quite beyond our scope here. So you can just ignore that part and move to deferred tax implication of share-based payments. And that's where we're going to start from today. So I hope that you had revised everything we have done. I hope so. So you see, for deferred tax, I know that Mr. Kazim has taught you deferred tax. I'm aware of that. And I want to believe that you all know that deferred tax is determined by temporary differences. So when there are temporary difference, then by the time you apply the tax rate on that temporary difference, you would get a deferred tax. So today now, what we are saying is this: temporary difference arise from a share-based payment transaction. That is what we want to look at. Before I get there, I want to also believe that you know that temporary difference is the difference between the carrying amount and the tax base. And you know that for carrying amount, it could either be the carrying amount of an asset or the carrying amount of liability. And the core principle around carrying amounts in line with IAS 12 is that the carrying amount is the amount the accountant has recorded in its own books. So usually the carrying amount of an asset for depreciable asset now is going to be cost minus accumulated depreciation for depreciable assets. For assets that are not depreciable, is going to be whatever you have in your books, whatever you have in your books. So if you have deducted items like maybe impairment that the tax man will not like from that asset, so your carrying amount has to be, you need to add it back because the tax man doesn't want, has nothing to do with impairment or valuation allowance. It doesn't want that. So he would have adjusted, he will adjust that back. But fundamentally, for your carrying amount is what you have in your books is your carrying amount. For depreciable assets, it's the cost minus the accumulated depreciation. That is the carrying amount of an asset, what the accountant has in his books, in the financial statements. And for liabilities, the carrying amount of a liability is also what you have recorded in your books. That is the carrying amount of a liability. IAS 12 did not refer to the carrying amount of an equity, right? So for IAS 12 purposes, what we are discussing today, carrying amount of equity is zero. So what we want to discuss today, which is share-based payment transaction. So when you are determining deferred tax or want to get temporary difference, you'll find out that the amount will always be zero because IAS 12 did not consider having a carrying amount for equity. So for deferred tax purposes, carrying amount is always going to be zero. Now, that is carrying amount. Tax base. So the tax base is what the taxman or the tax authority would have in its own books. That is the tax base. So for tax base of an asset, for example, now, for an asset that enjoys capital allowance, the tax base is going to be the cost minus accumulated capital allowance, which it's going to be the two-way DV for asset that enjoys capital allowance. For other asset that does not enjoy capital allowance, the taxman will look at what you have in your books. If you have any valuation allowance, you will disallow that, to probably add that back and says, no, you cannot revalue these assets. Taxman does not want to see that. He likes cash flow. So it's majorly your carrying amount. If there's any adjustment it wants to make, it will make it. The same thing applies to the tax base of a liability. It looks at if you have made any valuation allowance, the guy wants to adjust that to get his own value. That is the tax base of a liability. However, the tax base of an equity, which is the focus of today, again, what the taxman would want in his own book is always for share-based payment transaction now. Ultimately, what happens is that the company is going to compensate its employees with shares at certain value. For equity settled, the employee would pay an amount equal to either an intrinsic value or an exercise price. The employee pays when he wants to, eventually, when the shares are vesting, the employee pays either an intrinsic value or an exercise price. So for deferred tax consideration, that is what the taxman wants to hear. That's all the evaluation we are doing that I've been teaching you. The taxman does not like that one. That measure it at fair value of the share option at the grant date, or fair value for cash settled, fair value of the share option at each reporting period. Taxman does not like fair value. He dislikes it. So he will not deal with that. The guy will know what was the cash flow? How much did the guy pay eventually? How much did he pay? And that is what the taxman will allow. However, you see, the exam is always quite straightforward when it comes to deferred tax for share-based payments. I just want to recap so that you understand what we're doing. For deferred tax of share-based payments, the concern equity, because the transaction that is under transaction is what the entity is item. So for carrying amount of equity is always going to be zero. For tax base, that would be either the intrinsic value or the exercise price. That is going to be either the intrinsic value or the exercise price. Now, you then find out that the examiner in your exam, they will always tell you what the tax base will be. The examiner will tell you that, okay, this country, in their tax jurisdiction, the taxman only allow intrinsic, or they tell you that the taxman only allow exercise price. That means that's your tax base. And since your carrying amount is always going to be zero, so that means it makes it very straightforward. So in all cases, to calculate tax for share-based payment transactions, we'll need to get our difference, and have been shouting, the carrying amount is always going to be zero because IAS 12 didn't talk about the carrying amount of an equity, so it's always going to be zero. However, the tax base, the examiner will tell you what the taxman allow, whether it's exercise price, they will tell us and they will give us the value. So if it is the intrinsic value, then fine, that is what will be our tax base. If it's going to be the exercise price, then fine, that is going to be our tax base. So whatever it is, our tax base will have a value. So in that case, that means the tax base is higher than it will always be higher than the carrying amount. In this case, always. I didn't remember to on my video. It will always be higher than the carrying amount. Therefore, if that's the case, will this now be a deductible temporary difference or a taxable temporary difference? Because that's important. You need to know whether it's deductible or taxable. I don't know how you were taught, but in this case, because for share-based, right, the taxman is looking at, okay, should I allow this? Because you would have put it in your books as staff cost. For equity settled, you put a staff cost, put it in equity, both sides. So this is an expense as well as equity. When the taxman is looking at it in your P&L, he will say, should I allow this or not? So the taxman is not going to allow your valuation, but the taxman will only allow it in the future when the employee actually pays, which is time will allow the intrinsic value, the exercise price, what the employee actually pay. So whenever in the analysis, whenever taxman would, what he will recognize in the future will be an allowable deduction. Then we are looking at a deductible temporary difference. Whenever what the result is that the taxman is saying that, okay, I'm going to allow you this amount in the future, meaning you are going to enjoy a deduction in the future. Then deductible temporary difference, especially when the amount of deduction you would have is higher than what you have in your books now. So a deductible temporary difference. So in all cases, for different types of share-based payments, you will always have a deductible temporary difference. Rate on the deductible temporary difference, what you will have is a deferred tax. Asset. When you have a temporary difference, it's always going to be a deferred tax asset. And you know, if you remember what you were taught, deferred tax assets will only be recognized if the company would have sufficient profit against which they can offset deduction. Remember, deductible temporary difference is what will give rise to deferred tax assets. And for you to recognize a deferred tax asset in your book means that there has to be sufficient profit in the future for you to offset. But that's not even the focus here. Even though that's important, the focus is that the examiner would want to be smart with you. They can give you a carrying amount. Just know that to get the temporary difference, the carrying amount will be 0. And the tax base, they will tell you whether it's an intrinsic value or whether exercise price, whatever they give you, either of them. They can't give you the two, they'll give you either of them. Just pick that as your tax base. Tax base is going to be higher than the carrying amount because carrying amount is always 0. That means you would have a deductible temporary difference. Apply the tax rate on that. That gives you a deferred tax asset. And that's what we are looking at. So let's look at an example to settle that. Look at this question. It says that a company operates in a country where it receives a tax deduction equal to the intrinsic value of the share option at the exercise date. Look at the first sentence. That already killed it. They told us that it operates in a country where it receives a tax deduction equal to the intrinsic value. So they already gave me the tax base. The tax base is going to be in the intrinsic value. Then the next thing I'm looking at is this. Okay, what is this intrinsic value? How much is it? Then it's over. Then look at it. They said the company grants share option to employee on 1st January 2005 with a fair value of 4.8 million at the grant date. The intrinsic value of the option at the end of the year is 3.8 million. This is what I need, 3.8 million. And at the exercise date is 4.2 million. The intrinsic value of the option at 31st December 2005 is 3.8. And at the exercise dates, let me see, what will be the exercise dates? Okay, that will be the next year. Let's see. They now say the tax rate applicable is 30%, and the share option will vest on 31st December 2006. Okay. So this is a 2 years period, or a vesting period of 2 years, because the share option started at the beginning of 2005. So at the end of 2005, they say the intrinsic value is 3.8. And at the exercise dates, since they told me that it will vest on 31st December 2006. So that means this 31st December 2006 is the exercise date, because that's the vesting date. That's when the employee will actually pay this intrinsic value. So the intrinsic value is 4.2 million at that date. So that is what I need. I will need this one for 2005. I will need this 4.2 for 2006. The question now asks us that what deferred tax assets should be recognized, should be recorded in the financial statement for the year ended 31st December 2005 and 2006. So they want you to calculate deferred tax for 2 years. Like I did, a deferred tax asset would be recognized. It will always be a deferred tax asset. So at 31st December 2005, the deferred tax, the temporary difference or deductible temporary difference is going to be 3.8 because the carrying amount is always going to be 0. Always. And the tax base in this case is the intrinsic value, because they told me that the tax deduction is the intrinsic value. So my tax base is 3.8 million. So I will have a deductible temporary difference of 3.8 million. By the time I apply 30% on that, that gives me my deferred tax asset. However, because this is a 2-year period vesting period, so in the first year, just like the way we have been doing our calculation for equity settled and share and cash settled, for us to get the deferred tax attributable to year one alone, then you are going to do 1/2 years. The vesting period is 2 years. So for us to get that relating to year one, we'll have 1/2, and that would be 570. And I want to believe that you know that when you have deferred tax, the first leg is going to go to your income tax in P or L, because this is an asset now. It will be an addition. It is going to go as a credit to your income tax, to go as a credit. So it's going to add, it will increase your ability. It will go as a credit in your P&L because it comes in as an income. The other leg is going to be the deferred tax asset itself. But that's going to be, not going to be on the current asset. Deferred tax asset is always under non-current asset. That's how this is going to enter your financial statements. One leg goes to an addition in your income tax expense in P or L. The other one goes to your non-current asset. That's 2005. So it's this. Just know this, then you're okay. In the next year, 2006, again, carrying amount is always going to be 0. They already told me that at the exercise day, the intrinsic value is 4.2 million. That means my deductible temporary difference is 4.2 million. Is 4.2 million. So I multiply by that by 30%. I get a difference, because this is year 2. You can just maybe times 2/2. So that will still be 1. Then that gives me a deferred tax asset of 1.2 million. Now, for year 2, what goes to my P or L is the increase or decrease in that deferred tax. So by the time we do 160 minus 1260 minus 570, so that would be 690. So what we are putting in our P&L is going to be 690. So your P&L as an additional income under your income tax, it will just be an addition in that case to your PBT, while the other leg will go to your deferred tax assets, because the balance in your deferred tax asset is 570. By the time you increase it by 690, it increases it to this value that we have here. So you see, for your exams, these are the mistakes you can make in your exam. Number one is, I don't think you would forget that the carrying amount should always be 0, because IAS 12 does not deal with carrying amounts of equity. And that's what we need here. Okay, so it's always going to be 0. I don't think you will forget that. And I don't also think you will forget the tax deduction, because they will always tell you that. And in most questions we have seen, it's always the intrinsic value they will give you as the tax base, or as what the taxman allows as a deduction. I don't think you will forget that. What you can forget is this one. So you have to watch out for the vesting period. If it is 3 years, if it is 4 years, that means in year 1, what you will get, you should ensure you prorate it by 1/5 or 1/4, depending on the vesting period. In year 2, then that will be 2/4, depending on the vesting period. That's what you might forget. Additionally, is that in the second year, what you recognize in P&L is always the increase or decrease in those balances, or those figures you have gotten. Increase or decrease is what goes to your P&L. Is if a deferred tax, in this case now, it increased from 570 to 1260. So this difference is like an income. So it goes to my income tax, but it will be an addition rather than a deduction. Then the other leg will go to my deferred tax asset. So that's how it's always going to be. So at this date now, your deferred tax asset will become current tax, because it's already at the exercise date. It's going to be, it's eventually, as soon as it is settled, we'll cancel out the entire deferred tax we have in our books, provided that we have sufficient profits with which we can actually name it off, because we just write everything off to our P&L at the vesting date. So last two diets, that was May 2023. May 2023, ICANN asked this question. And again, whatever they have given you, you see, I would want you to look at this. Whatever they have given you, they gave you a lot of work, a lot of information. Like this cumulative expense for 2 years now is trying to tell you about the carrying amount, what the accountant has put in his own books. So if you go and use that as carrying amount, you'll be wrong, because carrying amount is always zero for income tax for IAS 12. Carrying amount of equity is always zero. And the tax base, they will tell you, let's see. Look at here. Tax allowance arise when options are exercised, and tax allowance is based on the intrinsic value. Is based on the intrinsic value. So they have told you that what they allow as deduction is the intrinsic value. But this question was not so straightforward in the sense that they didn't give you the intrinsic value directly. They wanted you to calculate it yourself. And the intrinsic value is just, by the time you compare the exercise price with the share price of the company, the exercise price in this for this guy was 4 naira. The share price of the company was 8 naira in 2021 and 8.5 naira in 2020. So that's what you are going to compare with the exercise price for you to get your intrinsic value. So I've also done the solution for you here, right? So you can look at it. If you have any challenge understanding it, let me know. But I will really appreciate that you try your hands on it, see if you can get that deferred tax asset yourself, okay? And there are a bit of technicality here because they gave you two different people and their grant date is different. Their vesting date is different. That shows that if you understand what we are doing, you are going to do for Adamu separately, and Chukwueze, you're going to do for him to be separately also, because if the grant date of this guy is 2019, 2021, so the vesting period is 2 years. And the question asks us that we should do deferred taxing from for the year ended 2020 and 2021. So for Chukwueze itself, the guy started in June 1st, 2020. So that means there will be nothing for him in May, because he started this thing in June after the first. So it's only for Adamu. You just need to get the intrinsic value, which is this 4 naira compared with this 8.5 naira. That gives you the intrinsic value. Multiply by these 400 options. And that's your tax base. Just the vesting period is 2 years. Whatever you do, by the time you multiply what you get by 30%, just do times 1/2. That's it. For the second year now, that means you're now going to do for the two of them, but do it separately. I just want you to try it yourself. Just boost confidence and just try it yourself. So I kind of asked it before. That diet, the performance was poor. They could come with it again. So I really want you to try your hands on whatever it is they are saying. Just focus on the fact that carrying amount should be zero, and the intrinsic value would be the tax base, unless the examiner now tells you that no, it should be the exercise price. Whatever they say is what we are going to follow. So you can look at disclosures also. Every standard has its own disclosure requirements, meaning further information you need to give to users to enable them understand what you're talking about in your figures. So you give disclosures, and the 3 disclosures I have here, which represent the main endings of this disclosure, is you need to provide information that make the user understand the nature and extent of the share-based payments, meaning that is it equity settled, is it cash settled? You need to explain, because if you just put it in your P&L remuneration, nobody will know whether it's cash settled or equity. So it's only if you state it in your disclosure, okay? you need to also allow user to understand how the fair value of the goods or services received are determined, and also the fair value of the equity instrument are determined. You need to explain that extensively in your disclosure, and also understand whatever you have in your P&L, what you need to explain the effects of this share-based payment transaction of all of those expenses on how it has impacted your profit. You need to explain it to you. Majorly, just all of those things that you will not have had the opportunity to put in your P&L is what they want you to explain to the users, like the nature and extent of the share-based payment, how you determine fair value of the goods or services received, or fair value of the equity instrument granted, and stuff like that. And that's disclosures. And I have some practice questions here. I have the solution there for you. So you are supposed to, they are practice question. Ordinarily, you're supposed to practice it yourself. I gave you some of them as assignments. And so you just have to go through all of this. And there was another past question that came in 2020. This was more straightforward than the one they asked in 2023. So, I mean, I think they want to ask it every 3 years, but that is a false prediction anyways. So that is it for share-based payments transaction. So we are done with that one. So
I have a question, please.
all right, Amaka.
So please, how do we know that it's supposed to be a deferred tax asset or liability?
Okay, so generally, for what Mr. Kazim has taught you, that has to do with assets and liabilities. So just follow what he taught you to determine that. But for equity, for this share-based payments, when the tax base is higher than the carrying amount, that would be a deductible temporary difference. And it is when you have a deductible temporary difference, then you are going to have a deferred tax asset. And like I mentioned earlier, for share-based payments, the carrying amount is always going to be zero, always. The tax base that they will give you, they will tell you whether it's the intrinsic value or the exercise price. So mostly in all the questions we have seen, they have always made the intrinsic value the pointer as to be the tax base. So for share-based payments, you are always going to have a deductible temporary difference. Always. And I've explained that earlier on, because the tax base is higher, and you are always going to have a deferred tax asset, since it was a deductible temporary difference that we actually have. So that's how you determine deferred tax assets in this case. But again, for share-based payment, it will never be otherwise. It is always going to be a deferred tax asset. Always, because the carrying amount is always zero here. Okay. For the other ones that Mr. Kazim taught you, I'm sure he didn't mention anything around equity. It's just around carrying amount of assets and liabilities, and also the tax base. And for that one is when the carrying amount of assets is higher than that of the tax base, then you'll be having like a taxable temporary difference. Then when you have a taxable temporary difference, then you have a deferred tax liabilities. So when you understand how it works for assets, just do the reverse for liabilities when there are differences in carrying amount and tax base. And that would really go a long way to solve these issues around determining deferred tax assets or liabilities. But what we're talking about today for share-based payment, it is always going to be a deferred tax asset, because we are always going to have a deductible temporary difference. Okay. Any other question? Okay. So we are done with IFRS 2. So let's go to IAS 19. Let's go to IAS 19. So what are we talking about here today? So for IAS 19, the major thing here is that let's even understand what employee benefit is. And you see, the definition, I intentionally define it here. So which talks about all form of consideration that an entity gives to its employees. All form of consideration that an entity gives to its employees. So whether cash or in kind. That is and employee benefits. Your monthly salaries, maybe they give you a car, maybe they give you a house, maybe they give you HMO. Just think about it. Any consideration that your employer gives you for working with them is an employee benefit. So what we want to look at today is how do you actually account for that? How do you account for that? So we will see that we're going to majorly look at the one that they pay you almost immediately and the one they pay you in the future, which is quite complicated. So we're going to look at all of that today. And so majorly, employee benefit is just always recognized as staff costs in your P&L as an expense. And the other leg would be like a liability if they have not paid it, a liability. But let's go into it. Let's go into it properly. So nobody will ask you definition of employee benefits, the exam and all of that. So the first thing we need to know is the categories of employee benefits. That's the first thing here. And there are 4 categories here. We have short-term employee benefits. We have post-employment benefits. We have other long-term benefits. And we also have termination benefits. So for short-term benefits, from the name, these are the benefits that the employer pays almost immediately or within 12 months. Almost immediately or within 12 months. And these are basically our wages and salaries, our monthly wages and salaries, and other allowances, all these basic pay and other allowances that you are entitled to it within 1 year. That's short term. For post-employment benefits, these are benefits paid to at completion of employment. At the completion of employment. And when we say completion of employment, majorly is going to be when you retire. That's when you have completed. When you retire. And again, you could decide to leave also. That's not post-employment benefit. Whatever they give you, if you say, I'm leaving, that will not be post-employment because you didn't complete your employment. So post-employment benefits is speaking to when you complete, meaning that you retired with them. So whatever they are now paying you is post-employment benefit. So payable at retirement. So we'll look at some things around it, right? So other long-term benefits, once they pay you after 1 year. And a typical example of that would be maybe long-term service award. Or maybe, to keep it simple, maybe they said they would give you a car if you work for them for 4 years. Those are, if that is in your contract right from day one, that's an other long-term benefits because you must work for 4 years to get it. So if you look at that share-based payments we learned that we just finished, before those share options will convert to shares, for an employee, he must have worked for several years. So that can also be an other long-term benefits, right? So those are other long-term benefits. And there is termination benefits. As the name implies, Either the employee says, I'm not doing again, I want to resign. Or the employer says that we don't want you again. You don't align with our culture here. Come and start going. Whatever way, what is happening is that somebody says, I'm leaving, or somebody says, leave. That's a termination benefit. If they happen to pay you for that exit, that would most likely be a termination benefit. For the purpose of your syllabus of this topic majorly, or from experience, we are going to focus on short-term benefits and post-employment benefits. So the much I can tell you about all other long-term benefit and termination benefit is what I've mentioned now, which you are going to see later in the notes. And I will explain why to you very soon. Very soon. Let me not explain it now to avoid confusion. So let me start with short-term and short-term benefits. So I've already explained to you that these are benefits you get within 12 months. And these are examples of them: wages and salaries, annual leave, all those allowances, whatever it is, those will be short-term that you are due for within 1 year. So how do you put that in your books? It's quite straightforward. So if it's paid, if they have, when at the end of the month, we expect that every entity has when they pay salary. So you debit staff costs as an expense, then the other leg goes to bank. The other leg will go to bank. However, if they don't pay it, if they are owing, accrual concept is that you are still going to accrue for the expense. It will still be in your books. Then the other leg will be a liability if they are owing, right? And if they overpay, that means we'll be having that excess as a prepayment in your books. By the time you have recognized what you are supposed to get in your P&L, whatever excess they have paid over what you are due to, then that will be a prepayment in your books. However, that's quite straightforward for your normal routine pay. However, there is one short-term benefit known as short-term paid absences. Short-term paid absences. And what that is speaking to is that there are a lot of payments you would get even when you are absent. There are some entities that will give you sick pay. Even practically, that doesn't exist anymore because most entities will do HMO now. But whatever the case, they will tell you that if you are sick, even with your HMO, if you are sick, that period you're absent, we'll still pay you. We'll still pay you your normal salary. So those are paid absence, or maybe leave allowance. Leave allowance itself is a paid absence. You are not around and they are still paying you. That's the definition is not what we are even looking at here. What we are looking at is that it can be straightforward in the sense that if the entity says that if you are absent, you get the money. But if you are not absent, meaning you didn't go for your leave, or you were not sick, or you didn't go for maternity, you are not going to get it. I mean, it's gone. You will not get paid that amount. Then the standard call that they call that non-accumulating absence. Non-accumulating paid absence. This one is straightforward. This non-accumulating paid absence. And why is this straightforward? In the sense that if the employee is not absent, or let me be specific, if he does not go on leave, that means we will not pay the employee. So that means we will recognize nothing in our books. There is no headache. We will recognize nothing in our books. That's not accumulating. But if the guy goes on leave, that means we will recognize that debit staff cost, credit bank. So that's straightforward. I don't see any examiner asking you that. Now, the one that could be tricky which is what most entity would do, I guess, is the one of let me stay on leave. That they will say that if you don't get your leave this year, you can get it, you can carry it forward to next year. Meaning you will still get paid for your leave allowance next year. I'm just taking it like, okay, that if you don't go on leave, we won't pay that leave we won't pay that amount until you go on leave. But practically most companies don't do that. They just monetize these things. Whether you go or not, they will pay you. So all of this accounting we are talking about here would not really apply in that case. But what we are talking about here is this. If you don't go on leave, your company says that, okay, you can carry it forward. And when you actually go, then you will get your money. The standard says that that one is an accumulating paid absences. Accumulating paid absences. So this one could be dicey in the sense that if an employee has 2 days leave, and for each of those days, they are going to pay the employee 100 naira. Just for example, they will pay the employee 100 naira. So that means for the 2 days, the guy should get 200 naira. But the guy did not go on leave. He did not go on leave. So he will go next year. Let's assume he will go next year. What we are saying here is this. Since it's our policy that the guy will go next year, that means at the end of this year, we still have to put it in our books that we are owing. That we are owing. So, and that's the main thing here. Accumulating, even though if they don't take that leave and we are not paying them this year, we still need to recognize that equivalent amount as staff costs in our books, and the other leg will be a liability. That's a very straightforward one, just like this question. If you look at this question, they said a company gives its employees an annual entitlement to paid holiday leave. It now said that if there is any unused leave at the end of the year, employees are entitled to carry it forward for up to 12 months. They now said that at the end of 2009, the company's employees carried forward 50 days unused leave, and they pay them 100 naira per day, show the required accounting. So that's straightforward. So it's just the 50 days multiplied by the 100, which is 500 naira. So for that year, even though we are not paying it, we'll still recognize staff costs, then we'll accrue the remaining, meaning we are owing it. So whenever the guy takes it and will pay, we just cancel out this liability in our books. I mean, these are accruals. Again, that one is also quite straightforward. However, where the examiner can confuse is this. Because we know that in reality, even though they didn't take it this year, and we are saying you can carry it forward, there's always a limit to which they carry forward. Like this question now, they said they can carry it forward for only 12 months. That means if you don't take it next year, it's gone. Depending. Some are not even up to 12 months. They'll give you up to the first quarter or second quarter. Whatever the case, question can tell you that, or the question knows that some people might not even take it next year again. So that's where the challenge will now come. The examiner can now tell you, like in this case now, where they told us that the employees, they can now give us an estimate of next year, because we are talking about this year now. We are trying to know how much are we owing people that did not take their leave this year. So the examiner can go for that and tell you that next year only 3 people will take it. They can tell you that next year only 3 people. It's not like they are sure, but accounting allows estimates, and we put estimates in our books in reporting. If they tell you that means it's only the people we are owing that we are going to recognize as liability in our books are the estimate of the people that will take it. It's only just 3 people we recognize liability for, because we see it as it's only 3 people that we are owing. if the question tells you that these are the only people that will actually take their leave, that's where you have to be very careful. And it's clear in the standard. The standard says that the cost of accumulating paid absence should be measured at the additional amount that the entity expects to pay as a result of unused entitlement that has accumulated at the end of the reporting period. The keyword is the additional amount the entity expects to pay. So it's acknowledging the fact that they might give you an estimate of the people that will actually take their leave next year. They might give you an estimate of that. And that is what we are going to rely on. And this is what this question is speaking to, this second part. So this question talks about Plyman. He said he has 100 employees. Each is entitled to 5 working days of paid leave for each year. And unused sick leave can be carried forward for 1 year. Okay, this one too is accumulating. They now said sick leave is taken on a LIFO basis, 4th out of the current year entitlement and then out of the balance brought forward. So what they are saying here is that if you carry forward leave, you have to use the leave of the current year first. If you have 5 days leave in 2023 that you not use, you now carry it to 2024. Before you can use the one you are bringing from last year, you must use that of 2024 first. If you now want to use the remaining, then that's what they are calling first out of the current entitlement, then out of any balance. So this one doesn't really affect anything we want to do. We're now told that at the end of 2008, average unused entitlement is 2 days by employees. Okay. So remember that they have 5 days leave. They are not saying that the employees, all our employees did not use 2 days. They didn't use 2 days. That means which they can carry forward because they already told us that unused sick leave can be carried forward. When I told that Plyman expects, based on the that 92 employees will take 5 days or less, it's 2009, the remaining 8 will take 6.5. Then how do you account for the unused as at 2008? Again, no matter how long the question is, the point here is this. What is happening in 2008? What is happening is that all of our employees, how many employees do we have? 100 employees. They did not use 2 days, which we are going to carry forward. But they didn't stop there. They went further. They say 92 will take 5 days in 2009. That means they are making estimates. And whenever they are speaking about future or a future years in the current period, that's an estimate because nobody is sure. So they are just trying to give us a clue on the number of employees that we should recognize as people who are owing money. They say 92 will take 5 days or less, but the remaining 8 will take 6.5 days. So here in this question, I can see that they didn't give us any figure because that's not even the challenge. The challenge is for us to get how many days are we going to actually pay for? How many days? So who can help us with how many days are we actually or are we owing this year? How many days are we owing this year? Look at the question, no rushing. Okay. Okay, nobody. So let me help you. So from here, even though we know that 2 days is being carried forward, so you will be wrong if you just say that since we have 100 employees, you now say that 100 times 2, so that means we are obligated to like 200 days that we have to pay for next year. They didn't give me the amount, then we'll have multiplied that. You'll have been wrong because the examiner went ahead to tell you that that based on past experience, which is expected to continue, 92 employees will take 5 days, right? So meaning that they're talking about, they're speaking to 2009. They are speaking to 2009. That 92 employees will take only 5 days. And don't forget, each is entitled to 5 working days. So every year they have 5 working days. So that means 92 employees will only take their 5 working days for next year. And don't forget, it's on LIFO. You will take the one of the current year first before you can start thinking about taking the one of the last year. So, and they told us that 90 take 5 days. That means next year, out of those 100 employees, 92 will just take their 5 days for 2009, meaning the one they are bringing forward of that 2 days, they won't take it. So it will not make sense for us to now put that as a liability in our books when, based on past experience, based on what this question is telling us, they will not take it. So that means we don't have any obligation on these 92 employees, but they said that the remaining 8 employees will take 6.5 days, meaning that still in the spirit of LIFO, first in, first out of the current year, meaning that they will take 5 days next in 2009, their normal 5 days first. But in addition to that, they will take 1.5 again. That's what makes this 1.5. And where is that 1.5 coming from? Is the one they are carrying forward from these 2 days. In fact, these 8 employees, they won't even take, based on the information they are giving us here, they are not taking the entire 2 days. They are only taking the only 1.5. So it's straightforward. The obligation we have as far as 2008 is concerned, based on the information we have now, is just on these 8 employees and on 1.5 days. Don't forget, all this information they are giving us is just an estimate of what will happen next year. So that will now give me a clue of how much am I actually owing in respect of unused 2 days. 92 will only take their 5 days. They are not taking any part of those 2 days. So no liability for that. 8 employees will take 6.5. So that means in addition to their 5 days in 2009, they will take 1.5 from 2008. So your answer is just 8 employees times 1.5 days. I think that will give you like 12 days. So, and the examiner will have given you an amount that they pay per day. Just multiply that by 12 days. Then you get your amount. So that amount will now be what you put in your staff cost in 2008 and also as your accrued staff cost. And that's that. So this question actually helps us with how you actually deal with accumulating paid absences, where the examiner gives you an estimate of what is likely to happen next year. So we rely on that estimate. Okay, the solution is here for you to look at. And that is still on paid absences, is profit share or bonus. This is also a short-term employee benefit where the employer will give bonus to their staff or a profit share. So when this happened, again, that means that will be an additional staff cost to the company. But before you can recognize this in your books, I mean, the company must have actually meet their target for declaration of profit or sharing profit. Every company has their own target. So meaning that the company is already has an obligation to pay you. That is, at the end of the year, they have prepared their management account and they see that, we have made so much profit. And they have told the staff that you are all entitled to profit share. They have made that statement publicly. So meaning that the employer has no real option but to pay it. In that case, then you can recognize that profit share. If it's 2.5% of the total profit or whatever percentage they want to give to all staffs, get it and put that in your books as staff costs. Since it's not something they will pay outrightly, it will probably be in the new year. So just accrue for it. Accruals. Okay, so there's no technicality here at all. So that is everything around short-term employee benefits. The good news is that it has never been asked before in your exams, and I see that trend continuing. If they are going to ask it, I mean, expect accumulating paid absences. That's one that might be a bit challenging, and it could be any other way. Your kind of exam is mostly easy, so they could ask this other one, but it's not something we have seen in your exams as a standalone question. Okay, so that's short-term employee benefits. Now we are moving to post-employment benefits. So this is what will take most of our time. Maybe not today, but I mean, we're going to spend the remaining 30 minutes we have for today on it. And also next week, we'll round it up. But before I move on this one, do you have any question on short term? Okay, so let's move to post-employment benefits. All the question ICANN has asked on IAS 19 has always been on this one. So focus. So now, again, what this is speaking to is this. Two things. Number one, post-employment benefits is paid at retirement. Is paid at completion of employment. That is when a post-employment benefit is paid. For that reason, we are speaking to the future. We are speaking about a future period. We are speaking about money we will pay to our staffs much later into the future. Imagine somebody like any of you in this class that is mostly in your 20s, your 30s, and most of us might be thinking about retirement, not yet. I mean, it's still like another 30 years, another 25 years, depending. It seems a long time into the future, right? So what entities do is that they usually have like a scheme, like a post-employment benefits scheme or post-employment schemes, or they call it a plan. So that is where those benefits will be kept. That's where it will be kept. And the focus of post-employment benefits is around this plan or scheme. How you account for post-employment benefits is all about this plan or scheme that the entity is maintaining. In Nigeria, what is obtainable is that you find out that the Pension Reform Act 2014 requires the employee remove 10% of his total emoluments, even though most entities do basic housing and transport. And employer will also contribute 8%, and there is voluntary contribution if you wish to. Then every month they are doing that, and they pay to PFA, Stanbic IBTC, Mansard. There are a lot of them, MPFL, a lot of them like that. That's the kind of plan I'm talking about here. That's contribution they are making into a PFA. So that PFA is a plan here. However, because the kind of plan an entity has is what determines how you account for it. So there are two plans, and that's where we are going here. Two plans that we have. Number one, there is the defined contribution plan. Number two, there is the defined benefit plan. And that's, as soon as we understand this perfectly well, everything we want to talk about on post-employment benefit is done. Okay, so let me summarize it to you like this. So I would just need to focus on what I'm saying so that you get it, then you move on. For defined contribution plan, let me put it as The promise the employer has made to the employee is that he will make a regular contribution to a plan. And that is it. The obligation of the employer ends at that contribution, which means that when the employee retires, if he goes to the PFA and say, give me my money, if they say, we lost it, we invested somewhere and we could not recover the money, we are so sorry, then you can only go after the PFA. You cannot go after your employer. That is a defined contribution plan. The promise the employer has, or let me put it as the only obligation the employer has, is to make regular contribution. And after that regular contribution, it ends there. Whatever they do with the money, wherever they are contributing it, it's outside the business of the employer. So for a defined contribution plan, I mean, you should understand it as the only obligation the employer has is to make a regular contribution. And that is it. So what the employee now gets depends on the performance or non-performance of that scheme or plan, whatever. But in Nigeria now, the way they have done it in a way that there is low likelihood that you will lose your money. The return might not be commensurate with inflation, especially now where inflation is running haywire, well over 25%, around 28%, as at the last data. So if you look at the return those guys are giving us, it's around 3%. So it's not so good. But I mean, your capital is still there. What they are contributing is still there, and it will be there because the law is clear on where they can invest this money, right? But that does not mean they can't lose it because now they just allow them to start investing in stocks. Stocks can tumble, so you could lose the money. So before, they restricted them solely to risk-free assets, meaning government securities, like that. But now they are expanding their scope. And there was even a time government was trying to borrow some of that money. Everybody kicked that. What is the meaning of that? Don't do that. Again, focusing on the key point for defined contribution plan is the obligation the employer has is just to make regular contribution, and that is it. If that's the case, then accounting for this is quite straightforward. In fact, it's extremely straightforward. That means at the end of every month, just know how much the pension, just calculate the pension, the 10%, the 8%, how much it is, put it in your P&L as an expense, whatever name you want to call it. If you want to call it pension cost, fine. If you just want to call it staff cost, fine. Just put that amount there in your books. If they have paid it, that means you take it out from your bank, credit bank. If they have not paid it, then you are cool for it. And they could overpay. And that will be a prepayment, depending. And that's it. That's all. So,
sorry, sir. I want to ask you a question, sir.
Please do, Fidelis.
Okay. In a situation where your employer fails to pay your pension,
yeah,
what are you supposed to do?
Well,
you come up with some reasons that the company is having some financial crisis and all of that. Plenty excuses. So are you supposed to file, sue him, or what are you supposed to do? I just want to make clarity.
Yes. So the Pension Reform Act 2014 requires that we report to there's a pension body, there's a regulatory body for pension. So the law requires that you report to those people, and those guys will go after them. In fact, they are supposed to be carrying out, in fact, the first job I did when I just qualified, the first job I got as an employee was I was working with an accounting firm, and the accounting firm got a job from the pension body that go and audit companies. We should go and audit their pension. So every month that a company fails to pay pension, there's a penalty for it. Every month. So we did the computation. Any company that was owing, we sent them letter. A lot of them paid. They paid penalty also. So they paid the company. So there's a law that's there that they must contribute. Just that a lot of people just don't do anything. But I think most employers do contribute, except the very wicked ones. But we see a lot of turnout because they will actually remove 10% from your money. So the worst they can do is now not contribute their own 8%. And it is compulsory that they do their 8% too. So to answer your question is that write letter to the regulatory body, they would enforce that they pay. And what is happening now is that if you want to get jobs, if company wants to get job in any government institution, you want to get contracts, you want to do anything, they will ask you for your certificate of compliance. Your certificate of compliance. If you don't have that, you will not get job. They will ask you for your life insurance policy, just to ensure that companies are doing what they should do for their employees before they leave, or before they die. Okay, so that's that. Fidelis, report them.
Thank you, sir. Thank you.
Yeah.
I appreciate you.
You're welcome. Okay, so in 2003, yes, 2003 May, I can ask 2 questions on IAS 19. One was in the theory parts. That was the question 1. That one they asked around defined benefit. I will get there. I will get to defined benefit very soon. The other one was on defined contribution. And for this defined contribution, they asked 10 marks. So I want to quickly go there. Then I'll come back to come and explain defined benefit plan. So let me quickly go to that past question. I've shared this material with you, so you see that what we have to do is a lot. It's long. Okay, this is the question. This question 2. This is a May 2023 diet question. And that diet, it came in under section B, question 4, 10 marks. I was angry though, because just too easy. So look at this one. Dovetail Nigeria Limited is into production of cashew nuts for global consumption. The entity has 3,000 employees on the payroll who are qualified for approved defined contribution plan. So they already told us that is a defined contribution plan. So the company makes annual pension of 28,000 per employees. I want you to press your calculator. Let's know the total pension they pay per annum. If they are paying 28,000 naira per employee and they have 3,000 employees, how much are they going to be paying per annum? I know that you don't have your calculator, so let me not waste our time. It's 84 million. So the 84 million is what you would simply recognize in your books as an expense, as pension costs. Just debit 84 million. If they have paid it, credit bank. So the first thing is that what goes into your books is 84 million to your P&L. However, let's see how much they paid. In 2006, they paid 150 million. Wow. As well as 119 million and 54 million in 2017 and 18. Okay. So we are now asked to, in accordance with IAS 19, how should the pension contribution be treated in defined arrangement? Very straightforward. So let's start with 2016. They paid 150 million, right? And how much were they supposed to pay? 84 million. So if you look at these workings I did, in my P&L, 84 million goes to my P&L. If you check this, I already put 84 million in 2016. But they paid 150 million. That means they overpaid. So there's a 66 million accrual, which I'll go and put in my current assets as part of my prepaid pension. 66 million. And that's it for year one. For 2007, they paid 190 million. Again, they were supposed to pay 84 million, but they paid 190 million. That means they have overpaid again. Whatever you get, don't forget that there is still an outstanding overpayment of 66. So that has increased the overpayment by 101. Again, in my P&L, how much are they supposed to pay actually? 84 million, that's my expense. My prepayment has now increased to 101 million. That gets carried forward again. Still supposed to pay 84 million, but in 2018, they paid 54 million. So here they underpaid by 30 million, but there was a payment of 101 million existing. So that has only reduced my overpayment to 71 million. I recognize 84 million in P&L, 71 million in my current assets. 10 marks. 10 marks. Any question on this one? Because I'm done with defined contribution plan. Any questions? No questions. Okay. Let's go to defined benefit plan. Now, this one. See, for defined benefit plan, the dynamics is quite different here, in the sense that the obligation the employer has is beyond contribution. Why? Because the employer is going to make a commitment. The employer is going to say that I will pay you certain amount of benefits when you retire. So it's either the employer has said in your employment letter, the employer said that, okay, when you retire, don't worry, I'll give you 50 million. Or they say, when you retire, I'll give you 2 million every year. They were so specific, right? Or they say that, okay, yeah, I'll contribute. Be sure that this contribution I'm making will be getting like 5% per annum return every year, even after you retire. Commitment. They have made a commitment for life. Or they tell you that when you retire, we're going to take care of your medical bills till you die, or we're going to take care of your children's school fees. If there's still anyone that is under undergraduate level, will pay their school fees. Or they tell you that would, they are just specific about the benefit they want to give to you. That's why they call it defined benefit. Is the benefit that was actually defined here. So if it's the benefit that is defined, then the obligation the entity has is continuous, is forever, is till you retire or till you die, right? So, and that will affect how we book for it, because this thing goes a long time. The employer has a long-term obligation. So a lot of things interplays here, because we are saying that, yes, the employer will contribute regularly, the normal contribution, because anyways, they are preparing for the future, so they'll still be keeping money and hoping the money will be enough. It's a defined contribution, so defined benefits, if when you retire now, you're supposed to be getting 1 million, but the scheme in which they have invested the money says that you can only get 800 for whatever reason. Maybe they didn't invest it well. It recurs back to the employer, because the employer has promised you 1 million. They have to make it up to 1 million. add additional 200,000. So you see, it's so uncertain because it's mostly about the future. For that reason, how do we, one, get the benefits we want to promise to the employee, like this is what we want to do? How do we even put that in our books? That, okay, we say we want to do that. How do we get the value? Because we're talking about future. And accrual concept will not allow you to recognize everything now in your books. You need to know how much are you recognizing each year in your books. How do you even determine the amount of contribution you are going to pay to meet that benefit? Because the Nigerian law of 10%, 8% is very specific that it might not work with these defined benefits. It might not, so for that reason, you see, defined benefit plan requires of valuations, and it is not accountants that do that. We are not trained to do those valuations. There are actuaries that do that. So they carry out actuarial evaluations. So I think the standard, they will use actuarial assumption to determine a lot of things, the benefits the company will pay, and there are ways they do it, and how much the company should recognize every year as a liability. So our focus is not how the actuary does his work, because I will not ask you that, and I don't expect you to do that in practice. Some of you that are in practice, if you work with an audit firm, if you go to any company, and you can see that the substance of the plan is that the employer has a continuous obligation because they have gone specific. They have promised something that I will do this, or I'll give you this Medicare. It becomes a defined benefit plan. As an auditor, the first thing you need to do is to ask the company to get an actuarial valuation of that plan. They need to, you just need an actuarial report. And that is the figures you need. So accountants are not trained to be valuers. No, that is not what we are training you to be. What we are training you to be is we want you to know how to recognize expense, measure transactions. That's our focus. And that we're going to focus on here. So, yeah, there are a lot of stories I have here. Now, let me quickly go to what you will find in the actuarial report. And what ICANN will ask you is, how do you account for it? They will tell you this is what the actuary has provided to you. And don't forget, this is a defined benefit plan. That's why we are going through this so much stress, because it's future, is uncertain. You have to do a lot of valuations and all of that. So we won't waste our time on how that is done. We would focus on the figures the actuary will give us. Now, the first figure you find there is contribution. So the guy will have done his own in his own training. He will have determined that, okay, for you to achieve these benefits, you said you want to give this employee, this is the amount you must be contributing periodically. And this contribution is done into a plan assets. When I say plan assets, you should understand it in the sense that we don't expect that they will be contributing the money and keeping it in a bank now, because this is future, like much later into the future. So we expect that this plan asset here, when I say contributing into a plan asset, it could either be stocks, it could either be mutual funds, it could be real estate, it could be insurance policies. That's where they invest those money, right? They invest it. Stocks, mutual funds, real estate, insurance policies, like that. So let's focus on the contribution for now. We'll still get to that plan asset yet. So they contribute. In your books, you recognize a plan asset, you debit a plan asset, because that's where the money is going. So you have a plan asset account. And the other leg is bank. The other leg is bank. If they have not paid it, just accrue for it. So this is what I can ask you. Your question will give you that this is the contribution they have paid under a defined benefit plan. Not defined contribution plan is straightforward. The contribution they pay, just debit, expense, credit, bank. That one does not need to go to assets. It's because they are making the contribution for the future. Is the company that will take care of any exposure. That's why the company has to this the company managing their stocks themselves, because they have committed themselves. So they won't most likely not find them using a PFA or whatsoever. So they put the money into plan asset, debit plan asset, credit bank with the amount of the contribution. This you have to know. This you must know. So your contribution will increase your plan asset. The second one that the actuary will give you is a current service cost. And this current service cost is the valuation the actuary has done as, okay, since they know that some people might leave, it's not everybody that will actually stay till retirement. So some people can live in 2 years, some can live in 3 years. So the standard call the method the actuary use, they call it projected unit credit method. You can see the examiner using that term in the exam, projected unit credit method. So it means that the actuary does it in such a way that every year the employee works for the employer. It's like the employee has created a benefit for himself in the future. So every year he works, the employer obligations increases. Every year the employee work, the employer obligation increases. So if you work for 5 years, that means every year of your working, there is a current service cost. So current service cost relates to that the fact that you have worked this year, we are already owing you this one for life. So if you work for 1 year and you now leave, that's what the entity is owing you. Is either they pay you in cash, or of course it should be in a plan assets. They will have invested the money. So it's just what they are owing you that you are entitled to. So if you stayed it to the end, that means it will have accumulated. So the idea is this: the actuary is going to give us this figure, but I need you to understand that is for your service in the current year. For the fact that you have worked in the current year, this is what you are entitled to. For the fact that you have worked in the current year, this is what you are entitled to. And usually the way the actuary does this is to get like the present value of the contribution. Like they will do a PV. Because when we say this is what you are entitled to, not now, is in the future. This is what you're entitled to in the future. And we in our books, we don't put future costs. You will never find an accountant anywhere. I will never teach you that we don't put future. Is maybe in SFM, you can be doing all that. In accounting, is historical or fair value. So usually the actuary will have done the PV of these amounts. The examiner will never ask you to do that. They will just give you current service cost. Current service cost. And all you just need to do is just to recognize that in your P&L, because that's your expense for the year. This is similar to the pension cost for that year. And you will credit a term called present value of, you credit a PV of defined benefit obligation. Credit PV of defined benefit obligation. So, I mean, in summary, this is the liability. This is what they are owing. This is what the employer is owing. This is where they will be accumulating it. So expense goes for the year. For the fact that the employee works, we recognize current service cost. Okay, you have worked this year, we expense it. They will now go and accumulate it. They call it PV of defined benefit obligation. The reason they call it PV is that is usually the actuary usually uses discounting. They discount those future benefits to present value. So it's a defined benefit obligation. It's like the obligation the entity has as a result of a defined benefit plan. So that's why they call it defined benefit obligation. So you find me calling it DBO. DBO. So when you hear me say DBO, this is what I'm talking about. So it is this one that you will now be carrying forward every year. So every year, there will be a current service cost that you will take to DBO. Every year, there will be a current service cost that will be in DBO. So after 5 years, for an employee that has worked for 5 years, if you go to the DBO, you will see how much the cumulative for the entire 5 years is in the DBO. You find there. You find it. So it gets carried forward like that. So that's the first most important 2 items. Then the second one is past service costs. Okay, so this one is maybe. It might happen, it might not happen. Why am I saying that? So it's majorly that recognizing the fact that this obligation I talked about here can change. And what can make it change is either an amendment or a curtailment. Amendment in the sense that the employer can introduce a new plan. For example, now they can say they are introducing a medical plan for their staffs. Maybe the company is doing well and all of that. So they now said, okay, we would provide care for all of you when you retire. So that's an amendment. So especially if it was not in the original plan, they just introduce it along the line. That we call an amendment. So when that happens, the obligation of the employer would increase because that means the actuary will go and calculate this contribution, which will increase the current service cost, which will increase the obligation. So that amendment will result into a change in the defined benefit obligation. That change is what we call past service cost. And it could be a curtailment also. It could be a curtailment. So curtailment is, to put it simply to you, is there is a closure of a plan. Maybe the entity they said that, okay, when you retire, we'll pay school fees of your children. They have factored that into their contribution and all of that. They just said, we are not doing that again. They closed it. So maybe there's a decline in performance. Maybe the company is liquidating, whatever the reason. The important thing is that they say they are not doing it again. They closed a part of a defined benefit plan or everything. That's curtailment. When there's curtailment, that will also result in a change in the defined benefit obligation. That change is a past service cost. And the thing is, they will give you in your books. They would give you. For past service cost, they can just give you a scenario. Mostly it's for past service cost. I've never seen them saying past service cost and give you the figure. So they will give you a scenario that, the company introduced a Medicare plan and it resulted in a change in the obligation by 40 million. You just keep quiet and be looking at you, whether you treat that 40 million or not. So if they give us that amount, just take the past service cost to your P&L. The other one will increase your obligation, especially if it is an amendment. That one will increase your obligation. If it is a curtailment, that would decrease it because curtailment is they are closing a part of a plan or everything. So that would debit obligation to reduce it, then P&L as past service cost. So that's that for past service cost. Then benefit paid, right? So I mean, somebody might actually retire, or somebody can say, I want to leave. I mean, I want to go to another company. So might have to pay benefits, but this benefit is actually speaking to somebody that retires, that leaves the company. So when that happens, that means that obligation will have to be settled. and this obligation is going to be settled with the plan assets. It's not like when somebody says he's leaving, the company don't know how, they don't have to go and be paying money again because they're already contributing into the plan asset. All they just need to do is probably sell some shares or go and liquidate some deposits, whatever, and get the money. So ultimately, your plan assets will reduce, your obligation will reduce. That's what benefit does to you, to the entity. It reduces the obligation, it reduces the plan asset. Okay. Then finally is settlement. So what this is speaking to is, you see, whenever there is a curtailment, where there is a closure of part or an entire plan, so for that, the entity would always have to settle. Because when you say you want to close, you have already been contributing already, so you just have to pay off your obligation. So now, when there's this settlement, the company might make some gains or losses depending on negotiation. So for example, now, if let's say what they were owing, what they have built up, the obligation, for example, has built up to like 50 million. Through the current service cost every year, it has built to like 50 million. And they settled with 45 million, meaning the plan assets they used in settling this, their plan asset only reduced by 45 million. That's a gain. That's a gain on settlement. You were owing 50 million. You only settled with 45 million. So that means your obligation reduced by 50 million, but your plan asset only reduced by 45. That's a gain on settlement. And the way we are going to trade this is just to put this gain in P&L. This 50 million will reduce your obligation. This 45 million will reduce our plan asset. And that's it for gain or loss on settlement. So from where I sit in your exam, you won't find more than all these I've discussed. For me, the most important thing today, as for defined benefit plan, if ICANN is going to ask it, is going to be around all of these things. And I've narrowed your notes to that. Just learn this, and our class next week, you will know peace, because you'll just be enjoying the class. Everything will just seems easy, 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 easy. So from everything I've discussed now, let me quickly show you. I explained some things around projected unit credits method there. In case you're interested in knowing what the actuary does, you can just read it. I just look at it. However, in your statement of financial position, from all I've discussed, what you put in your books as asset or liability is the difference between your obligation and the fair value of the plan asset, because the plan asset is always at fair value. At the end of every year, you might likely be doing an actuarial valuation, and the actuary will give you these figures. So you don't put the obligation separately, the plan asset separately. No, we don't do that here. So because it's not like you are owing them individually like that. There's already an obligation, and there's something you would use to net it off. So just get the net. So usually, if the obligation is higher than the assets, so we call that a deficit. A deficit. So that means your contribution is not enough, like a deficit. So we put that as a liability. It's the net. So it's either they call it a deficit or they call it a net defined benefit obligation. But if the plan asset is higher, that one, they will call that one the surplus. That means we have over contribute, like we full ground. They have over contributed. So that one, they call that a surplus, or they call it a net defined benefit asset. You will see all of that when we solve questions. That's the only thing that goes into your statement of financial position. In your statement of profit or loss, the current service cost, you go and check the double entry I gave you, current service cost, past service cost, gain or loss on settlement, and there's something they call net interest. Because of the fact that the actuary will have done present value. So whenever there is a present value in reporting, as you are moving through time, there will be an unwinding of discount through finance cost. And that's this net interest. I will show you how it's determined and the fact that it's always a net. You would understand better when we solve questions. But this is everything that goes to your P&L. And in your statement of other comprehensive income, if you have started this class with us, by now you should know that what goes to OCI are remeasurements. So next week, I will break down this actuarial loss and return on plan assets. You understand it better, you solve questions. And finally, ending this class, I will talk about changes in the effect of asset ceiling. That also goes to OCI. But again, you enjoy that better with a question so that it's not going to look fictitious to you now. We'll get there. But majorly, that's what you find in your position statement, P&L statement, and OCI. So what is left for us in this class next week is that we're going to solve this question. I'll explain it to you. We'll solve this other question. I'll explain it to you. Then under asset ceiling, I'll solve this other question too. I'll explain it to you. Then under practice question, I'll give you this as an assignment. And that is going to be everything for IAS 19. So we hope to finish up IAS 19 next week. And I'm going to call the class over for today. But please, I'm begging you, I know you will still not do it. I know you will still not read it. But try and read these things before you come to class next week, Tuesday. It's going to make the class interesting. If it's just the only one you read, if you can read the entire notes, good. But if you don't have the time, make sure all these ones all the figures the actuary gives to you, make sure you have understood it. Okay? As I'm speaking to all of you in this class today, make sure you read this part. You will enjoy the class if you really look at it, revise it next week. And when we are solving the questions, you're going to flow with it. Okay, guys, we are done for today. Do we have any questions? Do we have any questions? Any questions? Don't forget that you don't really have to talk. You can just type it. I'm seeing it. Okay. So no questions, I guess. That means we're going to see next week. Thank you very much for your time, for your patience. Evening classes is not easy for both for the learners and for the students. I know you're trying. So we would ensure, we'll put all our possible best to ensure you pass this exam, all the help we need to give you. And don't forget that for this online class, I am the coordinator for all the courses. If you have any challenge, if you need recorded classes on any courses, I'm just a chat away, and I'll immediately send you the link for you to get the past recorded classes for your revisions. So do have a wonderful night. See you next week, Tuesday. Bye-bye.